Guys, what's up? Welcome to this channel. It's your boy Sammy. In today's video, I'm going to be showing you how to trade up of the 4 hours time frame. I dropped a video earlier on last week, but this is going to be covering the full course. Okay, I want you to stick to me with me to the end of this video. I'm going to be showing you how I trade the 4 hours time frame using my own word analysis. Now, when it comes to 4 hours time frame, I always see it as what the day traders do to actually trade up of the market using daily candles and 4 hours time frame to analyze the market. But when we want to analyze 4 hours time frame, I would like you to understand something. We don't start from the 4 hours. We need to have a understanding of what the big picture is saying, because I've fallen victim of this off of many times. Like, what I mean by that is I come on my 4 hours time frame to see a market on the bearish move. Now, when you trade up of the bearish move, there is every tendency that you might make profit that day, but the next day when you come off the trade, you might still see that bearish move, but it will get to a particular order block that the market might reverse off of. Now, what is an order block? An order block is a region where people place their buy stops and sell stops and all of that. An example of order block that I'm targeting in this market is this region here. In this region here. Now you can see I placed a pending order there. It's actually a buy. Now what this simply means is I'm expecting the market to retrace down to this place and actually execute my trade for me and take me up to the upside. Now this is actually an order block. So many folks may think this market is actually a sell. So many persons are selling here, and they're expecting to take price to the downside, whereas I'm planning to buy. Now we have two types of traders in the market. Now, traders that buy and traders that sell. We have the bullish and traders that plan to buy on a trade on a particular order block, and we have traders that plan to sell on a particular order block. I'm going to be walking you down to two strategies that I like to use in the market. One, I like to look for opportunities to buy, and I like to look for opportunities to sell. Like what the market is doing here is actually ranging at this zone here. It's actually a range, and I don't get involved in that kind of a chart when I don't understand the market taking it what particular direction. Now, for those that are wondering what ranges is, range is actually a particular zone that the market is actually giving us no particular direction. It's actually on a particular zone, moving up and down without no particular direction, and it's not actually clear. You can agree with me that this market is bullish going up. At least we can look for opportunities to buy. But what is happening here, we can't look for any opportunity because we don't understand what is going on in the market. So let's dive right in and I'll show you what the strategy that I use. It is called the mirror strategy. I learned it from Renner. I'm going to be showing you how I use this strategy to be able to make profit off of in the market, to show you what I do. So if you dive right in, let's get ready. Okay, please, if you're here to subscribe to this channel, kindly do so. And if this is the first time watching your video, this video, I would like you to hit the comment section there and give the video a thumbs up, and also leave a comment in that section there, and subscribe so that whenever we drop a video like this, you'll be the first to know whenever we would have a content like this to show to you. So we analyze from the monthly. Let's go down to the monthly time frame. I like using trading view because trading view gives you a proper view, unlike the MT5 or MT4. I prefer using it to execute trade rather than just using it to analyze trade. It's two different things. I can place off of my analysis on the higher time on the trading view, or on derivative trading view, or whichever trading view that is clear. There's go chart also, and it's actually good for backtesting. If you are actually a beginner and you want to understand how to see your candlesticks break down for you to do a back test, I will actually recommend you go for go chart. That way you can be able to take out some candlesticks and practice on this strategy. Okay, let's analyze from here. As you can see from here, this market is actually on a down move, so we analyze gradually. Just stick with me. The market is actually bearish, so you're going to be analyzing from here. Good. The market is bearish, right? Because you see this zone here. Okay, then all of a sudden we had the breakout. Now all of this here is actually a range. It's actually a range. Why do I call it a range? You agree with me that this market was giving us swing points, major swing points, while it was coming down. Okay, before this breakout here that happened, and we analyze this to understand that this market is still bearish, provided it has not actually been giving us a higher high and a higher low. we can assume that the market is still what, bearish, and we'll be right. So what should we be doing? This is a secret. Please, we should be looking for opportunity to sell whenever we have one opportunity to do so. We should be looking for an opportunity to sell. Now, I'll tell you the one thing that I know. One of the things that I know is that this market is bearish. How do I know? Check very well. You see that this market break below this zone. Let me take this one out. Okay, this is better off. This market break below this one, so we can say this is a break of structure. BOS, break of structure. Now, why do I call this a break of structure? We see that this was our last major swing point, and this market that came break below it. So whatever that is happening here, whatever that is happening here is actually what, to trick out traders and make them look for opportunity to buy. Even if the market might retrace to the upside, we still know that the market is what, bearish. So it is better and safer for you to stay with the big money bags, okay, the smart guys that knows the market is what, bearish. This is just to make traders feel that, hey, this market is actually what, bullish. See, if I take you down to 4 hours, okay, let's move down to 4 hours. Let's move down to 4 hours. Let me show you guys something. From this 4 hours here, you will see something else, okay, that shows as if the market is actually bullish. Okay, let me see if I can get this thing out. Okay, I think we have it. Okay, this is it. No, now you see the picture here. You can agree with me that you cannot actually see the chart clearly. Somebody may be like, oh, since you're bearish, why do you tend to look for buys? I will show you. Okay, just stick with me to the end of this video. I will show you why I'm going with the buys, and I will show you where I place my TP, because I understand that the market might get to that zone. Okay, the market might get to that zone. So as you can see here, this market looks bullish, right? In the 4 hours time frame. 4 hours time frame is showing us that the market is bullish. Because if we draw our trend line here, I think I'll just close this and move to, okay, sorry, if we move back to the 4 hours time frame, see where we are. This market shows bullish. It shows that we are going up, but in the monthly, the market shows what, bearish. So now we analyze from the monthly down to the 4 hours. How are we doing so we get a better picture of what the market is saying? So let's move down back to the monthly and understand what the market is actually saying, so we can be able to analyze from there. Okay, okay, this is it. This is the monthly time frame. So now what do we do? Let's do an analysis from this place. Like we said, this actually is a break of structure, which shows that the market is actually what, bearish. Because why? We have not started giving ourselves higher high. Okay, this, let me quickly just identify these things here so we can get a better picture. Guys, this is it. This was the last order block, major order block that took price to the downside before the break out of here, out here, sorry, yeah, for the break out here and this funny move here. Now we know this market is bearish because why? We have not closed here and we have not equally closed the top. Okay, you have not closed this two zone, we have not closed here, so we say this market is still bearish. So as long as this zone remains, the market is still what, bearish. So what are we going to be doing? We're going to be looking for opportunities to sell, but we don't just sell, we have to sell in an area of value. This is where the mere formula comes into play. Okay, let's analyze. Let me say I want to sell this zone here. Okay, let's look at this point here. I'm going to be using trend line. Okay, I'm going to be using trend line. Now first of all, what's the market structure? Now I need to pick a pen and a paper so you can be able to get this mere formula. The first thing we'll write is M. The M stands for market structure. Now the market structure here indicates that the market is bearish. So once you get your M, you write your M and you write by the side my market structure bearish. Now we have the market structure here. The market structure is what? Bearish. Good. The next thing is we want to check, is the market in an area of value? The next one you write is area of value. Under the M you write area of value. Now that area of value now talks about the market in a significant area where you can look for opportunity to sell. How do I mean looking for opportunity to sell? Because why? The market structure is bearish, so we want to flow with the market. Okay, so now market structure is what? Bearish. Now what do we do? Market structure is bearish. Market structure is bearish. Okay, let's get that point clearly. Good. Market structure is bearish. So now since we say we want to analyze from the higher time frame, what are we going to be doing? We've seen this whole move here, all this funny moves here. The market is bearish. So what are we going to be doing? We'll go to the 4 hours. Okay, let's start from the daily. Okay, I'm skipping weekly. Let's start from the daily. The daily time frame. Yeah. Now this daily time frame is going to be showing us area of value. What does daily time frame simply means is it takes 1 day for each of these candles to be formed. Okay, it takes 1 day for each of these candles to be formed. Okay, the first one we say market structure, right? The market structure is bearish. The next one is area of value. Now for the sake of this video, the area of value we are going to be identifying with our indicator is on just trend line. Okay, trend line is just what we are going to be using. Trend line is what we are going to be just what using. Don't forget, I drew this trend line from actually the monthly. Okay, now the daily now is not showing me what this thing is about. It's showing me what this whole stuff is about. I think I might analyze from here. Now area of value. Area of value is the next one. Now the next step is we need to see market structure change indicator. Now what is market structure change indicator? It talks about your double top, your chart patterns. I think I've dropped a video about it last week also. I left a video about chart patterns. Now when we talk about bearish, we have double top, a market that is turning from bullish to bearish. We have a double top, or we have a triple top, or we have a head and shoulder. Now analyze from here. What do we have? We can see a double top here, or can I call this a triple top? Whichever way, I can call this a triple top. Yeah, let's just call it a triple top. This one is not valid. Please take note. This one is not valid. Let me identify it out. This is not valid. But we have 1, 2, and 3. Now we have a triple top, right? Don't forget the first thing that I said is market structure. Market structure is what actually what bearish. Market structure is actually what bearish. Now the next one is what? The next one is area of value. Area of value is what? The trend line. What is a trend line? The market must be touching the trend line. Don't forget, I drew the trend line from the monthly time frame, and in the daily the market is actually touching the what? The trend line, and you can see it here. So after the area of value is touching the trend line, and from touching this trend line, it's going to give us a reversal chart pattern, which happens to be a market structure change indicator, which in this case is a triple top. So we see our triple top. What does triple top stand? It stands for a reversal, market reversal, that shows that the market was actually bullish here, which was a retracement that was taken to the what? Trend line, which is the area of value, and it gave us a triple top, telling us that we want to turn from bullish to what? To bearish. Now the next one is this. The next one is this. After market structure, area of value, we have our area of value. So you write market structure, bearish, area of value, trend line. Now the next one is entry strategy. Now we have three types of entry strategy I like to analyze. We have aggressive entry, we have pullback entry, and we have breakout entry. Now in this case, now this entry here shows us an entry trigger in place. Okay, this entry here is an aggressive entry. When the market formed the chart pattern, you immediately enter. This is an aggressive entry here, and you put a stop loss above it. I like to give it space in the top stop loss somewhere above here. Yeah, so that the market can actually have this zone to itself before turning down. Now take note, what is stop loss? Stop loss is actually an area in the chart where you place your exit point, telling the market that should, in case the market comes to that zone, you're willing to what, close your trade, no problem. That is what the error of the level of mistake you're willing to what accommodate in the market. So this area of value here, this stop loss here is cool for me because the market has opportunity to what move. This might be 20 pips, 30 pips, or 40 pips, depends on your own risk appetite. Okay, so the next one we have is after the entry strategy, we have aggressive entry, we have a pullback entry. Let's see if we can get the pullback. Let me analyze this thing once and for all. Okay, we have the pullback. Please take note of this. Let me quickly just say this, I think, so that we don't get confused. Whenever a market forms a chart pattern here, the second time it's coming, it might not form a chart pattern again. Okay, it's just going to be called either a pullback or a breakout. The market might not form another chart pattern again, but in this case it actually formed. Thank God, that was an opportunity for some other folks that are good with chart pattern, all of that pattern. I'm going to be showing you one of the ways to identify this chart pattern also. Okay, stick with me to the end of this video and I'll show you. Now this actually formed a triple top again, giving us what, an entry opportunity. But for some reasons the market might not form another chart pattern for you to what, get involved. You have pullback. I wouldn't call this a pullback, but it is a good one to enter though, but I'm not cool with it. For my own strategy, I'm not cool with it. Then we have the breakout here. Identify this out, breakout from this zone here. Let's see if we can get it. Okay, I think we have it. This is it. You can see it here. Now what is a breakout? After the market has come below this zone here, the one that actually led to the move up here, this one here, the market is going to be coming back to respect it for us to get what, an entry back. So if we take this pull back here, sorry, let me point this out back. Please, if you're getting any value in this video, I would like you to subscribe, leave a comment in the section below, and let us know if you get any value from this video. The best you can do for us is subscribe and leave a comment in the section below. Okay, this was the breakout. Like I said, this was the breakout strategy here. Breakout, this can be the pullback, and this is the aggressive entry. I love to enter this one. I love it. And one of the reasons is because I love my SL to be above here. I love my SL to be above here, so that whenever my SL is above there, I'm a swing trader though, so in case you want to know, I'm a swing trader. So what I do is I leave my SL there and I keep watching the market, because why? There's one thing I've gotten to understand about the market. Whenever the market gives me a reversal chart pattern, it is very hard for you to come back there. Okay, that is one of the things I've gotten to discover. Now see it, the market gave an aggressive order, so when I see this move coming back here, I'm always not scared. Because why? I know, because it's going to be reversing back. It will not just come here and break my chart pattern, except for some certain reasons. But before it will do that, let me show you why I'm confident. I will tell you Why I'm confident is because it has to give me a signal, and what's the signal? There must be a trend line break and a return back. This is to warn me to leave the market. Whenever I see a trend line break like this back, I know the market is giving me a signal that I should leave my trade, I should close out my profit. But it might not be immediately because it went back to the downside. That has a way of boosting my confidence to tell me that, hey, okay, that gave me a signal for me to leave the trade. Okay, so before I'm able to actually exit my trade completely. But whatever the case might be, it is always cool for me to stay. Even if you're staying here, just make sure your excel is in a reasonable zone. If I'm entering here, example, I would put my stop loss above here. Okay, reason is because I want to give the market space to play out. One of the reasons beginners lose money is because they put their stop losses in areas that the market will definitely come back to. You have to identify areas that your stop loss is supposed to be, good zones that the market should not come to immediately. So okay, that helps you to be what in advantage. Now the next one is, we talk about market structure, we talked about area of value, we have talked about entry strategy, and now the next one we want to talk about is entry triggers. Now what is an entry trigger? Okay, what is an entry trigger? An entry trigger is actually um, a signal for you to place your trade. Now, let me say this. I like to use candlesticks. I created a video about candlesticks, about bearish candlesticks and bullish candlesticks reversal pattern. Whenever a market comes to an area of value, either an aggressive entry or a pullback or a breakout, it will definitely give you an entry trigger. Now, for this case of this bearish market, we're going to be looking at bearish candle reversal chart patterns, and in the areas you're going to also supposed to enter. Now we said the first one is market structure, we have ticked it as bearish. The next one is trend line and trading strategy. The next one is area of value, and we have ticked in trend line. And the next one is entry strategy, and in this case we're going to be looking at aggressive first of all. So let's tick aggressive entry, and then the next one we're going to be looking at is entry trigger. What is our entry trigger? Okay, I need you to stick with me. Some of you may say this information is too much, but please, when it comes to markets, forex market, eventually, we actually like to be detailed. Okay, so whenever we are tracking our records, it's easy for us to understand what is working and what is not working. Okay, so let's zoom out and see the entry strategy we have here. From this aggressive, let's see what we have. Okay, I see a bearish reversal candlestick, as in a shooting star. I see it here. Okay, let me take this one out. Shooting star here. That is for the aggressive entry. So you can, if you're an aggressive trader, you can actually tick in aggressive entry as shooting star. There's another aggressive entry here, but in this case we had a reversal chart pattern, so I called it. It can be a pullback. Okay, this one gave us an investor here, entry here, stop loss above here. Okay, this one gave us what, an healing star. Now let's see what the breakout gave to us. Okay, breakout actually gave us an evening star too. Sorry, a shooting star here and stop loss what above it. Now I'm gonna be able to cover. Okay, let's talk about the bullish candle, bullish market structure using the mere formula. Okay, okay, this is a bullish market on iron gold. So let's start analyzing from the monthly like we did the last time. You agree with me here that this market is actually bullish because price actually what moving to the what to the upside. So we're going to be looking for opportunities in the lower time frame to look for opportunities to take price to the upside. Please, when if you're trading a bearish move in a lower time frame, you have to be able to understand what the market is doing in the higher time frame. But for me, I like to stay um, with the flow of the market. That way, I'm able to what make good profit and I'm relaxed. Because now, okay, let me tell you a secret. The secret I got to find out in the market is that when the market is actually bullish, okay, in the market is actually bullish, and you are trading with the market, it is very hard for price to actually come back to that zone where you entered the market from. That is how you win on the long run, okay? It is very hard for price to come back to that zone immediately. But if you are against the trend, you might be stopped out at any time because there is bound to be what a retracement. Take for example somebody that was selling here. Someone was selling here. Sorry. Someone was selling here. The person would have been stopped out by now because why? This was just a chart pattern that was being formed. Whereas the person in the lower time frame was thinking the market was bearish. You have to come to the higher time frame to get the big picture. It is after getting the big picture that you go down to the lower time frame. And somebody was saying, do I enter using analysis from the higher time frame? Like let's say I come to the daily and I do analysis. Tomorrow, should I come and do more analysis before going back to trade? Yes, you should. In every day, if you're a day trader, fine. If you're a swing trader, you can do it once. Okay, once in a week is cool, no problem. Okay, but you need to understand what the market is saying. But I will advise, even as a swing trader that I am, I do analysis every day before entering the market. I do a back testing every day before doing over entering the market. Why do I do that? It gives me a clearer picture of what the market is doing, and that way I'm able to what understand what smart money is doing, understand what the big banks are doing, understand what is going on in the market and how the market flow is. Now, I was actually part of the guys that were selling here, yeah, but I made losses when the market got to a particular zone. I made losses when the market got to a particular zone. Now, why did that happen? That was because when I got to the lower time frame, I saw a good, strong, bullish momentum candles. Now, this was telling me that the market was bearish, and I saw my entry trigger, my analysis, everything was accurate. And the market gave me 30 pips. I was 30 pips here at some point, and I never wanted to close it because my minimum pip target is actually 50 pips. So I didn't close the trade, and after some time, I was stopped out. Though it really didn't affect me because that was what I was willing to risk. Okay, so I got to find out that when you want to stay longer in the game, you have to know what you're risking. Okay, so I was able to risk what I was willing to lose. So when I got the next day, because whenever I trade and I'm done for that day, I come back the following day and find out what happened. Even if it plays out in my favor or even if it goes against me, I try to find out what happened. That way I'm able to stay profitable in the market. So when I came back to find out what really happened, I got to find out that what I was selling was actually in a range. Guys, it was actually in a range here. The market was actually in a range, meaning the market was in a what? In a channel, a descending channel. So what I was like, so I was selling here. Good. I learned something from it, no doubt. All my strategy has played out. Now, what do I mean by all my strategy has played out? See, if you look very well, this market is actually touching this trend line, and I drew it in the 4 hours. It really touched the trend line, and it really gave me what a market structure change indicator, which shows a double top, and I was able to sell an aggressive entry. I was cool. I've been selling ever since, but the market came to the zone without me knowing that it wanted to reverse. So I was there busy in my 4 hours looking for sales, whereas the market has already changed and telling us that we're about coming out of what the channel, whereas I was selling, so I was stopped out. So what am I saying is You need to get a big picture. Ever since that day, I need nobody to tell me that, hey, I have to analyze from the monthly to the weekly to the daily to 4 hours. Then I can base up my analysis and my entry. Please take note of this, even if you don't get everything that I said from this video. Lower time frame is actually meant for entries, not analysis. I'll say it again. Lower time frame are actually meant for entry, not analysis. You don't go to the lower time frame like 15 minutes, 30 minutes to do analysis. Except you're a scalper and bet me scalpers just look for 3 pips, 4 pips. Is that what you want? If you want something like 30 pips, 40 pips, or 50 pips move, you need to be able to get analysis from the higher time frame, and that way you are able to stay profitable in the long run. So this was it. Okay, this was the mistake that I knew, and I'm going to be sharing with you what I know in the market, and I'm doing that already. Stay with the higher time frame. That way you are able to what, be relaxed, but don't get too overconfident when you start winning, because you're bound to what, the market will bring you back to your knees if you become too what, confident. Okay, confidence is good, but overconfidence is not. I'm going to be telling you something that is very vital at the end of this video. Just stick with me before I end this video. Okay, let's move on to the bullish mere formula. Okay, this market is actually bullish, like we said. So I'm going to be analyzing this here. Okay, now how do we know this is bullish? Like I said, this was a descending channel. It doesn't mean the market is going to be changing price immediately. Okay, so let's use something smaller. Okay, if you look closely, you see another descending channel here. Can you see it, guys? But the market is bullish. Some folks will be selling. There is nothing wrong if you are able to use that strategy and it works for you. There's nothing wrong. But for me, I like to stay bullish. That way I'm confident about my trade and my strategies. Okay, so let me identify this. I've talked about this video over and over again, but I love gold. Some folks be like, gold is crazy and all of that, but I don't know. I just love it. Love it because it's cool. It rewards me for my patience. That is one of the reasons I love gold. So you can see that this market is actually bullish. How did we know this was the first entry here? Aggressive entry here, and then we had a breakout. I'm going to be explaining it. I wasn't able to explain it in the last video. I'm going to be explaining it in detail here. Okay, we have the clearer picture of what the market is doing, right? So let's go down to 4 hours. Okay, we've been able to identify from monthly, right? If I'm not mistaken. Let's see. Okay, it's a 4 hours time frame. So as you can see here in this particular zone, the market touched these trend lines, touched this one, touched this one, and we had a break down after this large swing point at the upside. We had a breakout. Now what does this simply mean? Whenever I see a breakout out from that trend line, it's an indicator telling you that the market wants to move from bullish to bearish. Don't forget, okay, you want to move from bullish to bearish. Now how do we get this mere formula in this? Now the first one we say market structure. M stand for market structure. Market structure here is what? It's bullish. So you write M and you write bullish, or you write market structure and write bullish. Now the next one is area of value. Area of value. Now area of value is actually the trend line, the market coming to the trend line. And when the market comes to the trend line, it simply means the market is an area of value. Now the market is an area of value here, so you write trend line, area of value, trend line. The next one is this market structure change indicator. For the sake of gold, gold does not always give market structure change indicator. Please take that. It doesn't always give it. That's why each market has the way they move. Okay, I was telling my mentees to actually choose a strategy, a market in the a currency pair in the market that actually works with their pattern of trading. Okay, not all the market will work with your pattern of trading. While as a beginner trader, I will advise you go for Euro pairs. Okay, the one that actually respects your trading pattern. But if you say you want to stick with gold any other oil or crude oil or any other pattern of trading strategy that goes well with you in the market, it is fine for you to do so. But first of all, you have to identify, does it respect what you know? That is the most important thing. Rich Dad Poor Dad said something. He said, what I know gives me money, and what I don't know lose me money. Okay. If you don't want to continue making losses and feel forex is actually frustrating, I would advise you stay with one currency pairs. Okay, while as a beginner. Now, for the sake of gold, please, gold does not always give you the chart pattern. Once it comes to that trend line, it is telling you that hey, we are about going up, and you look for opportunities. But it gives something that I love, which is the next one, entry and strategy. We talked about market structure, bullish area of value, trend line, and what's the next one? The next one is entry strategy. Now, entry strategy in this scenario, let's zoom in and see which of the entry strategy gold actually gave to us. Which of them did it give to us? Let's zoom closely so we can get a better picture of what gold gave to us. This is crazy though. Okay, this seems like a continuation chart pattern. I haven't talked about it, but I plan on dropping a video about it now. But let me just quickly analyze something. Now you see this bearish candle here, this last one here, sorry, this last bearish candle here. Okay, these other candles that were moving here did not actually close above it until we got a bullish candle. Now this shows the continuation chart pattern. How do I mean? Whenever we see this kind of candle, a single one candle, and there is no actually other candle that covers above it, but all of a sudden we see another candle that comes to cover and continue, it shows we are actually moving to the what, upside. Now when we got to this other block, we got another entry here when the market came to the trend line. We got a preceding pattern which shows that the market wants to what, go bullish. Now, preceding pattern talks about a candle that covers above 50% of the previous candle. If you look closely, you see this bearish candle here. Okay, this last one here. But the bullish candle that showed up next to it was able to cover above 50%. This is a good entry, and it puts your stop loss to the downside. Now, I need you to understand something. When you go down to the 30 minutes, some of the time it might not give you what you're seeing here, but it is good to always stick with the trend line, mostly in the 4 hours. Okay, once you have the trend line in the 4 hours, going down to the 30 minutes, you will always see some kind of funny moves. Stick with what the 4 hours is giving to you. But let me open your eyes, please. Get me clearly. Okay, this is where the mistake is. How do I know when to execute my trade in the 30 minutes? I'll tell you. You see this bullish candle here that is being formed here at an entry trigger to take price to the upside. Once the market is forming this bullish candle, the 30 minutes is going to change structure. It either give you a double bottom or a triple bottom. But for gold, I said it hardly gives, but it will definitely give you an entry trigger that confirms what the 4 hours is doing. It is when an entry trigger is being formed in the 4 hours, that is when you should look for opportunity to enter. When these other bearish candles are being formed, please keep waiting in 4 hours until you see an entry trigger here before going down to 30 minutes. The only thing that should move your eyes and take you away from 4 hours should be the entry trigger, okay, that is being formed that you saw. Okay, don't ever come to 30 minutes and when you see these candles you believe that they are going to be coming to this trend line before you go down to the 30 minutes. No, make sure you see the entry trigger first. What is an entry trigger? It what tells you that the market is about to what, go. Now let me analyze this in a simple format. Market structure is what, in the higher time frame, monthly is bullish. Okay, you write bullish and you write monthly. Okay, let's get this picture clearly. Okay, you write monthly and weekly too, they always align. Then area trend line you can do 4 hours, you can do 1 hour, it's fine. Trend line, which is an area of value, trend line you can do 4 hours. Okay, then entry trigger, entry strategy, please make sure entry strategy is 4 hours. Don't go down to the lower time frame and look for entry strategy. No, wait for 4 hours to be what, confirmed. Now how is it being confirmed? Once the entry trigger is being formed in the 4 hours, then go down to 30 minutes and look for your own entry. Once this bullish candle is being formed, which serves as an entry trigger, the same thing applies to the word bearish candle. Don't come here and say you want to look for opportunity to buy here. No, you might be wrong. Okay, where you should be coming to is these zones, the place that touches the trend line. Make sure your trend line, if you've not known how to draw a trend line, I created a video. I will leave in the link in the comment section, all that will help you get profitable in the market. I'm definitely going to be helping you, and drop it in the comment section, the links, okay, and the titles also. So you're going to be looking at the entry trigger that is being formed. That is when you move from 30 minutes. When the market structure is being formed, you can do it on weekly or daily. Daily, fine, I'm cool with it. Okay, market structure is clear on daily, no problem. It's clear on weekly and monthly, fine, no problem. But once it comes to area of value, please, one, daily. If you want to do swing trading, it's fine, you can use daily. But if you want to do day trading, please stay in 4 hours. Stay in 4 hours and make sure the market is touching the trend line. And once it is touching the trend line, still wait until you see a reversal chart pattern in the bullish, either a preceding pattern or a bullish engulfing. Once that candle is being formed, or a morning star, once it's being formed, you can now go to your 30 minutes and confirm the trend line. Okay, then you can now look forward an entry trigger to place your trade. Okay, an entry trigger. So let's summarize it. Market structure, bullish. Market structure, bullish. Daily time frame, weekly time frame, or monthly time frame. I'm cool. Area of value must be 4 hours. What do we mean by area of value? The market must be touching the trend line. Area of value. Okay. The next one is this. The next one is uh, entry strategy. The entry strategy is either aggressive or a pullback. This one in this scenario is actually a pullback. As you can see, market has gone up. It was a pullback. Okay. Once the pullback is being formed, which of the entry trigger is being formed here? You now write entry strategy. You now look in this one. We have the entry trigger being formed. You now go down to the 30 minutes and write your entry trigger. What's the entry trigger? Your entry trigger here in the 30 minutes might be a bullish engulfing chart pattern. You write bullish engulfing chart pattern. Then the last one is exit. How do you exit your trade? I will show you. If you're doing a swing trade, I will show you when to exit your trade. I told you this course is going to be covering all my strategy that I use in 2024, and I want you guys to be profitable in the market. I don't think forex is a scam. It's actually helpful. Okay, so I'm going to be showing you how to exit your trade. Now, don't forget, after entering your trade, we have two trend lines. Now this one is going to be a little bit complex, but I want you to stick with me. Okay, I want you to stick with me. Now, how do I mean? Don't forget, we draw our trend line from here. This is the overall trend line. Nothing was touching it at this zone, right? But was there was something else that was going on. If you go down to the 30 minutes, please, I need to confirm this. Okay, in the 30 minutes, you go down to the 30 minutes, see that this other zones was being respected. See, I drew two trend lines. Now, how do I know? Once this first trend line, this one that I drew here, once it's been broken, let me see. Okay, let me just do it like this. Once this first trend line, I don't know why this thing is overdrawing. Oh, okay, I think that's better. Once this first trend line is being broken, it signifies that the market wants to break the second trend line. It's going to be coming to this first one here and pull back to the second one before coming back down to break the second one. So your focus should be the first trend line, not the second one. But this is not in all cases, okay? It happens only in some cases. But perhaps this thing happens in the market. Focus on the first trend line. Once this one, if you're a swing trader, that's what I'm saying. If you can leave your position for days, once this first trend line has been broken, you exit the trade. This first one here. Once it has been broken, you exit the trade. Because the next time the market is coming is to break the second one, okay, before coming back to confirm it and take price to the downside. I think this video was really helpful because I was able to show you my secret in the trading industry. Okay, if you find any value in this video, don't forget to like, subscribe, and leave a comment in the section below. And also, if this video has been helpful, our anniversary is coming up tomorrow, so if you were actually being profiting or being impacted by any of our videos, please let us know in the comment section. Okay, Thank you.